The issue with the S&P 500 isn't that it's a poor investment. It's that it's the right investment applied at the wrong moment. And for most Americans past 50, the window to use it the way it was intended has already shut. The math transforms completely the instant you shift from depositing money to withdrawing it. And that transition is more destructive than nearly any market collapse you've ever read about. Americans in their 50s today hold a median retirement savings balance of $460,000. Americans in 2026 believe they need $1.46 million to retire comfortably. That's a shortfall of roughly $1 million. And the default response, keep everything in the S&P 500 and allow it to grow, isn't a strategy. It's a wish dressed up in historical performance charts. I'm going to explain precisely why and precisely what the actual structure looks like when you build for the road you're genuinely traveling rather than the one you were on a decade ago. Here is what this video is going to accomplish. I'm going to walk through why putting everything into the S&P 500 after age 50 is the wrong move. Not because the index is flawed, but because you're asking the wrong instrument to perform the wrong function at the worst conceivable moment in your financial life. Every advantage the S&P 500 delivers during your accumulation years reverses when you transition into withdrawal mode. By the time this video ends, you'll understand the precise mechanism, the actual numbers, the psychological trap that keeps people locked inside the wrong portfolio design, and the 3 structural decisions that genuinely determine whether you deplete your money in your 70s. Let me offer you the central framework. Think of the S&P 500 like a high-performance sports car, not a flawed machine, one of the greatest vehicles ever engineered. On a dry, open highway, it's flawless. It rewards aggression. The long, straight stretch of your 20s, 30s, and even 40s. That's the territory where it thrives. You hold the accelerator down, absorb the occasional rough patch, and the machine rewards your patience. But now you're somewhere past 50, and the road ahead contains a sharp hairpin turn in wet conditions. A precise technical corner that demands careful deceleration, not raw velocity. You don't take that car through a tight hairpin at full speed. Doesn't matter how brilliantly it performed on the straight sections. At full throttle through that bend, you're going into the barrier. Same vehicle, same driver, different stretch of road, completely different outcome. That image will resurface every time I introduce a new layer of this problem. The car hasn't changed, but you are absolutely on the wrong section of track. In a few minutes, I'm going to show you what happens to 2 identical portfolios when the only variable is the timing of their losses, and how that difference compounds into $665,000 on the same opening balance. But first, I want to explain why most people never see this problem until the moment for fixing it has passed. The reason is that during your accumulation years, volatility actually works in your favor. When markets fall and you're still contributing, you're purchasing more shares at reduced prices. Dollar cost averaging is a genuine structural advantage. Volatility becomes your ally. The S&P 500's harsh swings function essentially as a discount program for long-term investors. So you spend 20 or 30 years conditioning your mind to tune out volatility. And that conditioning is entirely appropriate for the first chapter of your financial life. The problem is that the brain doesn't revise its model when the chapter changes. Most investors spend decades focused on one figure: average annual return. They assume that getting the average right will make retirement straightforward. However, for anyone drawing income from a portfolio, average returns tell only part of the story, and arguably not the most important part. The other half is sequence. The order in which returns arrive during the opening years of retirement can permanently alter outcomes even when long-term averages end up identical. This is called sequence of returns risk, and it is the most dangerous concept in retirement finance that most people have never encountered. 2 retirees both average 5% per year across 20 years. Both withdraw $50,000 annually from $1 million portfolios. The only distinction is when losses occur. Same average return, yet a $665,000 difference in ending balance. And the portfolio with the unfavorable sequence was in serious trouble by year 5. $665,000 difference on the same average return, the same starting balance. The only variable is the order. Sequence of returns risk describes how the timing of withdrawals combined with market declines can determine how long retirement savings actually last. Your first 5 years of retirement represent the danger zone for drawing from accounts during a downturn. According to a portfolio strategist with Morningstar Research Services, if your portfolio declined at least 15% in your first year of retirement, and you also withdrew 3.3% of the balance, that combination would increase the probability of depleting the portfolio within 30 years by 6 times compared to someone who experienced a positive first year. 6 times. Same portfolio, different first year. This is not a peripheral risk. It is the central mechanical failure mode of every all-equity retirement portfolio. Here's what that looks like in practice. The collapse of the technology bubble in 2000 initiated a prolonged bear market. From March 2000 through October 2002, the S&P 500 lost more than 47% of its value across more than 2 years. A retiree who began withdrawals in March 2000 from a $1 million S&P 500 portfolio, pulling out $50,000 annually, watched their portfolio fall to roughly $455,000 by the end of 2009. Even by the end of 2019, following a strong recovery period, it remained below $400,000. This illustrates the danger of depending entirely on the S&P 500 in retirement. The same $1 million left untouched would have survived and eventually compounded, but with withdrawals, the damage becomes permanent. Not because markets failed to recover, they did, but because every share sold at depressed prices to fund living expenses was a share no longer available to participate in the rebound. Forced to liquidate assets at low valuations just to generate that same $50,000 in income, each withdrawal carved a much larger slice out of a contracting portfolio, creating a devastating downward spiral that becomes extraordinarily difficult to reverse. That's not a market failure. That's a portfolio design failure. You don't take a high-performance sports car through a sharp corner at full throttle. And before you say, but 2000 was exceptional, the decade of the 2000s, frequently described as the lost decade, produced a compound annual growth rate of approximately negative 0.95%. The only negative decade since the 1930s. Individual decades vary dramatically from negative 0.9% in the 2000s to positive 19.4% in the 1950s. An investment of $100,000 in the S&P 500 at the start of 2000 was worth just $90,934 at the close of 2009. The situation deteriorates further when you factor in inflation. Over that decade, the Consumer Price Index climbed more than 28%. The combined effect of stock losses and rising inflation produced a total loss in purchasing power exceeding 37%. A lost decade, without question. It happened before. It can happen again. That's not pessimism. That's pattern recognition. Now here is where the analysis sharpens. Because sequence of returns risk isn't exclusively about market crashes, it's about a specific window researchers refer to as the retirement risk zone. The probability of portfolio failure for a retiree who experienced a significant market shock at the point of retirement is 50.6%, compared to only 33.5% for a retiree who encountered the same shock 15 years later. This is precisely why managing the retirement risk zone, the 5 to 10 years immediately surrounding the moment you stop working, is the most critical task in constructing a durable financial plan. Same shock, same portfolio, different timing. 17 additional percentage points of failure probability, based purely on when the market chose to break. That's nearly 1 in 5 additional people who exhaust their savings. Not because of poor decisions, but because of when the calendar fell. The hairpin turn. Following 3 consecutive years of strong performance, including a 17.9% total return in 2025, the S&P 500 began experiencing difficulties in early 2026. This remains one of the least discussed risks in retirement planning. With the S&P 500 recording 5 straight weeks of losses and sitting roughly 5% below its starting point as of late March 2026, It carries particular relevance for investors who retired within the past year or two and are now drawing from portfolios in a declining environment. For those who retired in 2024 or 2025 and are currently withdrawing funds, the sequence risk dynamic is no longer theoretical. They are living it, selling assets at reduced prices to cover expenses, permanently shrinking the number of shares available to benefit from any eventual recovery. By the way, hit subscribe if you're finding this valuable. Otherwise, the platform's algorithm may stop surfacing this content to you entirely. Now, the financial industry's traditional answer to this problem has been something called the 100 minus your age rule. This general guideline suggests subtracting your age from 100 to determine what percentage of your portfolio should be in equities, with the remainder allocated to fixed income-like bonds. At 50, that produces 50% stocks and 50% bonds. Clean, logical, and increasingly outdated. The problem is that this rule was designed for a world where retirements lasted roughly 10 years and bonds generated meaningful income. Using your age to dictate your stock-bond split is the default framework for retirement investing. But now that retirement can extend 30 years or more, it's time to reconsider the assumptions underlying asset allocation entirely. S&P 500 total returns, with dividends reinvested from 1950 through 2025, show that even the worst rolling 20-year period still produced a positive annualized nominal return of roughly 6% per year. That means if you have a genuinely extended time horizon, reducing equity exposure sharply at 50 actively sacrifices compounding. But here's the critical distinction. A portfolio has two completely different jobs to perform, and most people only ever design for one of them. Job 1 is the growth engine. This is the accumulation machine. Maximum equity exposure, long time horizon, letting market volatility work in your favor. The S&P 500 is precisely right for Job 1. It's the sports car on the open highway. Job 2 is the distribution machine. This is the withdrawal architecture designed to generate income, buffer against unfavorable sequences, and protect the compounding base during down years. The S&P 500 alone is exactly wrong for Job 2. After 50, you need to begin constructing Job 2. Not by abandoning Job 1 entirely, but by deliberately building a second portfolio layer with a completely different purpose. Most people have a single pile of money and assume it can fulfill both functions simultaneously. It cannot. That is the design error. The traditional guidance to shift toward bonds as you age is an oversimplification that can leave retirees underinvested and running short of funds. Modern retirement portfolio research points to a more nuanced approach, including a temporary bond tent at retirement, followed by a rising equity allocation through the retirement years, as a strategy that meaningfully improves outcomes. A bond tent begins with a temporarily elevated bond allocation at the point of retirement, then gradually increases equity exposure in later years. The underlying logic is that the first 5 to 10 years of retirement carry the greatest sequence risk. Once you navigate that window with your portfolio intact, expanding your equity share helps ensure you don't deplete your savings in your 80s or 90s. That last point surprises nearly everyone. Research suggests that in later retirement, you should probably hold more equities than conventional wisdom recommends, not fewer. Because longevity risk, outliving your savings, becomes a greater threat at 85 than sequence risk does. The S&P 500 is well suited for combating longevity risk, but it needs to be properly positioned within a broader structure. You can't simply pour everything into one account and hope the timing cooperates. Understanding these numbers and actually constructing a system around them are entirely different things. I spent a long time holding accurate information while operating with an inadequate plan, because data without structure produces expensive confusion. That's why I created a resource called The Exit Code. It's a digital book grounded in 50 years of actual retirement data. Not opinion, not market forecasting, not motivational content. It's a mathematical framework that converts "I hope this is enough" into a specific date and a specific number. Inside, there's a thorough breakdown of what I call the 4% trap. Why the standard withdrawal guideline was engineered for 30-year retirements, and how it breaks under modern longevity assumptions. alongside a dynamic withdrawal method that responds to market conditions rather than mechanically drawing down your portfolio in a down year. Morningstar tested multiple dynamic withdrawal approaches against a conservative baseline of fixed inflation-adjusted spending each year. Every flexible strategy the researchers examined supported a higher starting safe withdrawal rate than the fixed approach. That section alone changes the math for most people who encounter it. There's also a chapter on what I call the 58% rule. Because more than half of workers retire earlier than planned, typically due to circumstances beyond their control. Your strategy needs to survive not just your intended exit date, but the forced one that statistically arrives 3 to 5 years sooner. If your plan only holds together under ideal conditions, it isn't a plan. It's a wish with a spreadsheet attached. And there's a complete analysis of the invisible expense, the insurance gap that surfaces when you exit employment before Medicare eligibility at 65. The enhanced premium tax credits that had reduced marketplace insurance costs since 2021 expired at the end of 2025 and were not extended into 2026. For early retirees, this means anyone earning above roughly $62,600 as a single individual pays full market price for coverage, which can exceed $1,500 per month at age 62 in certain geographic areas. That figure needs to be embedded in your model before you make any retirement income decision. You can access the exit code through the link in the description. It costs less than a single dinner out, and it won't send you a recurring invoice for 1% of your assets to explain half of what it contains. Now, back to why the math deteriorates further the longer the healthcare component goes unaddressed. Here's a dimension of retirement risk that people consistently miscalculate because it's completely invisible while you're still employed. You have employer-sponsored health coverage. Your employer absorbs most of the cost. Healthcare feels like a minor line item in your monthly budget. Then you retire, and the real bill arrives. Healthcare represents one of the largest expenses Americans face throughout retirement, yet it remains among the most difficult to project accurately. According to Fidelity Investments' 2025 retiree healthcare cost estimate, the average 65-year-old who retired in 2025 will spend an average of $172,500 on healthcare and medical expenses throughout retirement, not counting long-term care costs. A 2026 report by EBRI found that some couples may need as much as $469,000 in savings to cover retirement healthcare expenses alone. To have a 90% chance of meeting healthcare spending needs, a man will need approximately $212,000 saved specifically for that purpose, while a woman will need $252,000. Couples enrolled in a Medigap plan with average premiums will need $267,000 for a 50% chance, and $450,000 for a 90% probability of covering those costs. Those figures exist entirely outside your 401k. They represent a parallel financial obligation sitting quietly alongside your investment portfolio, growing on its own independent schedule. The standard Medicare Part B premium increased 9.7% in 2026, rising from $185 per month in 2025 to $185, wait, to $220.90. This marks the third consecutive year that Part B increases have outpaced Social Security's cost of living adjustment. The 2026 Social Security COLA added roughly $50 per month to the average retiree's payment. Medicare Part B immediately absorbed $18 of that through the premium increase. The net gain was $32. Healthcare inflation does not negotiate, but here is the genuinely costly problem. That scenario applies to people who already have Medicare. Medicare doesn't begin until 65. According to the 2025 EBRI Retirement Confidence Survey, the median expected retirement age among current workers is 65. The median actual retirement age among current retirees is 62. That 3-year gap has persisted across decades of surveys. If you retire at 62, which represents the statistical midpoint, you face 3 years of private health insurance costs. Estimated average monthly benchmark premiums climbed to $1,072 at age 62, $1,111.80 at age 63, and peak near $1,120 for those aged 64 to 65. A couple in their early 60s faces a combined full-price silver benchmark premium of approximately $2,849 per month before any tax credits. That amounts to roughly $34,188 per year before deductibles, co-pays, coinsurance, and prescription costs. Now apply that to your withdrawal model. If you plan a 4% withdrawal from $500,000, $20,000 annually, your healthcare costs before Medicare already consume that entire amount and push you $14,000 negative before rent, before groceries, before a single discretionary expense. The 4% rule was not designed to absorb a $34,000 invisible obligation during the pre-Medicare years. It was built assuming Medicare was already active. According to HealthView Services, an average healthy 65-year-old couple's annual healthcare costs are projected to rise from $17,030 in their first retirement year to $55,513 by age 85. That growth trajectory means a healthcare budget that feels tolerable at 65 has effectively tripled in real terms 2 decades later. This expense is compounding against you on an entirely separate track from your investment portfolio, and the S&P 500's historical 10% average must battle through all of it simultaneously. Let me introduce someone here. We'll call him Dave from Ohio. Dave is 52. He holds $480,000 in his 401k, invested 100% in the S&P 500. He plans to retire at 65. He tells himself 13 more years. The market averages 10% historically. I'll compound my way to $2 million and I'm done. Dave isn't thinking about the retirement risk zone. Dave isn't thinking about the healthcare gap. Dave's plan works flawlessly. If markets cooperate, if he remains employed until 65, and if his health permits him to make that choice. We'll return to Dave, and the ending differs from what he anticipates. Here is the difficult reversal at the heart of this entire conversation. You assume the problem is insufficient money in equities. The actual problem is having your entire investment architecture built around a single instrument that generates no income, offers no downside cushion, and delivers maximum volatility during the precise window when volatility inflicts the most permanent damage. This isn't about the S&P 500 being inadequate. It's about using a growth engine as your sole distribution vehicle. Those are different machines. Constructing both is the genuine task. Stay with me, because what follows changes the calculation for most people watching this. There is a plan that nearly everyone with a saving shortfall assembles in their 50s. It goes, I'm behind, so I'll work until 67, maximize contributions across the final 15 years, let market growth do the heavy lifting, and retire with enough to make everything work. Clean logic. One substantial flaw embedded in it. More than half of workers, at 58%, retire earlier than planned, typically because of circumstances they didn't anticipate. The median age at which they actually leave the workforce is 62, 3 years short of the conventional retirement age of 65. That 3-year discrepancy has persisted for decades. It is not a recent trend. It is the baseline. Your plan to work until 67 is a plan that statistically fails more often than it succeeds. The Employee Benefit Research Institute and Greenwald Research found that 46% of Americans who retired last year departed the workforce ahead of schedule. The forces driving those early exits should concern anyone who assumes they will determine when their career concludes. Unexpected health conditions and corporate restructuring were the two dominant factors pushing workers out before they were ready. According to the 2026 EBRI survey, circumstances entirely beyond the individual worker's control accounted for 76% of all unplanned early retirements. 76%. You're not the driver. You're a passenger who believes they're steering. Consider what this does to the standard keep contributing and stay in the S&P 500 approach. That strategy requires continued contributions. Contributions require continued employment. Employment is something that 76% of early retirees discovered was not genuinely within their control. So the strategy, maximize contributions, maintain a long runway, let compounding do the work, carries a structural dependency that the math never acknowledges because the math assumes you control the timeline. A separate EBRI study of 3,600 retirees between ages 62 and 75 found that 58% had retired ahead of schedule. In that study, 38% identified health problems or disability as the primary driver, while 23% pointed to employment disruptions. These findings matter because many workers operate on the assumption that they can simply extend their careers by a few years to compensate for insufficient savings. That assumption is a strategy built on a dependency that may not hold. Now, return to Dave from Ohio. Dave is 52. His strategy requires 13 more years of uninterrupted employment. Statistically, Dave is more likely to stop working at 62 than at 65. 3 fewer years of contributions. 3 additional years of withdrawals. And if Dave encounters an unfavorable sequence in his first few years of involuntary retirement, with his $480,000 entirely in the S&P 500, no cash buffer, no bond allocation. The sequence problem and the healthcare gap activate simultaneously. They don't simply add to each other, they multiply. That's the mechanism by which people who did everything responsibly still exhaust their savings at 72. Incidentally, the somewhat ironic version of this situation is that Dave's financial advisor, upon hearing all of this, will say, "Stay the course," delivered with considerable conviction while collecting 1% of Dave's assets annually. Financial advisors often note that retiring into a strong market can provide favorable momentum, while the reverse can erode a portfolio over time. Accurate, and vague enough to apply to any eventual outcome. The arithmetic on stay the course on $200,000 over 30 years at 7% average returns. A 1% annual advisory fee costs you approximately $373,000 in forfeited compounding. $373,000 for guidance. I respect the business model. I simply want you to understand what you're purchasing. And for Dave specifically, Dave is actually doing reasonably well right now. He occasionally leaves comments suggesting these videos are unnecessarily pessimistic. Dave, the sports car is extraordinary. I appreciate it. I drive one too. I'm simply asking what your plan is for the wet hairpin that appears roughly 12 years ahead, because I've reviewed the map and it is unquestionably on the route. Let me make this concrete with specific figures. You are 53. You hold $500,000 in a 401k, invested 100% in the S&P 500. You plan to retire at 65. Your target retirement spending is $60,000 per year. Scenario A, you execute the plan without interruption. Markets cooperate. You contribute the full $23,500 annually, plus $8,000 in catch-up contributions. As currently permitted for individuals aged 50 to 59, that's $31,500 per year across 12 years. At a 10% historical average, your portfolio at 65 reaches approximately $2.1 million. You withdraw $60,000 annually, a 2.8% withdrawal rate. You have meaningful capacity to absorb a sequence problem. The S&P 500 fulfilled its role. Sports car, dry highway. This scenario works. Scenario B. You're forced out at 61, 4 years early. You miss 4 years of contributions, roughly $126,000 in deposits, plus their compounded growth. Your portfolio at 61, before any market disruption, sits at approximately $1,100,000. Then the market falls 25% in your first year of involuntary retirement. Not an unusual event. The S&P 500 dropped 25.4% between January and October 2022. Your balance contracts to $825,000. You need $60,000 per year in living expenses, plus private health coverage costing roughly $12,000 annually for 3 years before Medicare eligibility kicks in.